All right, so we will go ahead and get started. I didn't introduce myself. I'm Brittney Goodrich. I'm an assistant professor here in the Department of Agricultural and Consumer Economics here at University of Illinois. I'm acting as the host today and the presenter. Todd Gleason is out doing something very important, I'm sure, so we'll have to forgive him for not being here today. It's a busy time of year. So today we're going to talk about some alternative agriculture insurance products. So most folks in Illinois are going to be familiar with kind of the typical revenue protection for corn and soybeans, but a few of the topics we're going to cover today are pasture, rangeland, and forage insurance. This is a product for livestock and forage producers. And there's also an almost identical product for beekeepers called apiculture insurance as well. We're also going to talk about livestock risk protection, which is a price protection product for feeder cattle, fed cattle, and hog producers in Illinois. And we'll touch on whole farm revenue protection, which is a product for diversified producers. So we'll go ahead and get started. We're going to start off with pasture, rangeland, and forage rainfall index insurance. I'm going to go kind of quickly through a lot of this because I do have another full webinar on this topic that you can find on the FarmDoc Daily website. But this is something that is a crop insurance program. It's offered by USDA Risk Management Agency, a subsidized program like all of the different crop insurance programs. And this is something that's going to provide livestock and forage producers with insurance against drought-like conditions that would potentially affect your forage production, which might, increase your cost of production or maybe make you have to sell off cattle earlier than you had anticipated. So this product specifically will cover perennial pasture, rangeland, and forage. So it's not going to cover here in Illinois annual forage products. So livestock and forage producers are likely familiar with some of the catastrophic coverage programs for drought-like conditions, so livestock forage disaster assistance, and you can also get non-insured crop disaster assistance or the NAP program. So these products are going to cover, if we have a catastrophic drought event that really severely decreases your forage production, those are going to kick in. What PRF is, or this pasture, rangeland, and forage insurance, is an additional buy-up coverage. So this is going to be something if you maybe have a below average rainfall year, but it doesn't quite hit that catastrophic level, but your hay or your forage production still suffers. So PRF is kind of this buy-up option. So this is showing what PRF enrollment looks like across the U.S. In 2024. You can see kind of east of the Mississippi, there is a lot less enrollment than maybe some of the western states, and those states are obviously going to be a little bit more drought prone than we are. But about 6% of eligible forage in Illinois is actually enrolled in PRF. So there's definitely a lot of room for improvement, not improvement, but increased enrollment if folks are interested. This kind of varies throughout the state. So there are some counties that you can see here, Kendall, Grundy, Hancock, Jefferson, Hamilton, that have kind of higher average enrollment. So, from 20 to almost 30% of the total forage in those counties are enrolled in PRF. And so there are also a lot of counties that haven't had any PRF enrollment at this point. So PRF is going to be, it's an area-based insurance product, and it's not going to be directly based on your forage yield. So you're not going to actually have to report that to USDA or to your crop insurance agent. They use these grids that are established by the National Oceanic and Atmospheric Administration. And these grids in Illinois are about 13 miles by 17 miles. And so for each of these grids, there's going to be a rainfall index that's calculated using the 4 closest weather stations to the grid. So they might not be in your specific grid, but they might be in another grid nearby. And so you would use the 4 closest ones to calculate that rainfall index. So a few of the different decisions that you're going to have to make with PRF, you're going to have to decide for your forage area whether you're going to ensure kind of hay production or pasture production. You can guarantee anywhere from 70 to 90% of historical average rainfall. And then what makes PRF different from kind of traditional crop insurance products is you're actually going to choose the months you want to insure against that low rainfall. One of the benefits of PRF, I think, is that there's no minimum number of acres that could be insured. You could, I guess, insure 1 acre if you really wanted to. And you don't have to insure all of your hay or pasture acreage. So you can kind of pick and choose and decide which pasture or hay acreage you want to enroll. So again, we kind of touched on this a little bit already, but you have to choose whether your the acreage that you're enrolling is going to be used for hay production or grazing. And so if it's going to be used for hay, you also have to choose whether it's irrigated or non-irrigated. We don't really have that much irrigated hay here in Illinois. So it's mostly going to be non-irrigated. And then you also can choose, if you're an organic producer, you can choose organic certified, transitional, or conventional. And basically what these decisions are going to do is it's going to determine the county base value of your policy. And this is basically going to affect your premium and how much you'll be paid out if there is a lack of rainfall or a below average rainfall year. So these county base values are determined for each county by the Federal Crop Insurance Corporation. And so they're basically trying to determine the value of that crop. So for grazing and non-irrigated hay production, for these county base values, those are kind of meant to cover the price of alternative feeding if there is a low rainfall year. For irrigated hay, this is really meant to cover additional irrigation costs. And so these are they're given based on where your grid is and what county that you're in. But you still do have some control over kind of what the actual value is that you insure through this productivity factor. And so you can think about it as, is your acreage more or less productive than other pasture or hay acreage in your area? And so you can kind of adjust that county base value from anywhere from 60 to 150% of the county base value. So if your acreage is higher than what you think the rest of, or higher productivity than what you think the rest of your county is, you can kind of indicate that using, a higher 150% or anywhere from 100 to 150% productivity factor. So there's a lot of room for adjustment with these policies. So yet another decision with PRF is you have to choose what coverage level you want, and that coverage level is going to determine at what percentage of average rainfall do you want the payments to kick in. So when you have a higher coverage level, that's going to mean a higher cost of insurance because you have a higher likelihood of payout. So there's going to be way more years that are 90% of historical average rainfall than there are 70% of historical average rainfall. And with most crop insurance products, probably all crop insurance products that are offered by USDA, The subsidy levels, so the amount that the government's paying on your behalf, is going to vary with the coverage level that you select. So the lowest coverage levels are going to get the highest subsidy, percentage subsidy, and then the highest coverage levels are going to receive the lowest percentage subsidy. Okay, so again, one of the decisions for this PRF product is that you have to choose the time of year you want to insure against low rainfall. So you have to make these decisions. You get to decide between 11 2-month intervals, and you kind of allocate your coverage across those 2-month intervals. So placing any coverage, I give the example here, placing 20% in the 2-month interval of March and April is going to ensure that 20% of your policy value against those low rainfall months. So it kind of determines how much you're going to get paid if and when a low rainfall event occurs. So with these 2-month intervals, with all crop insurance products offered by USDA, they're really designed to be actuarially fair. So that means that over time, indemnities paid out should approximately equal the premiums that are paid in. And so because of that, each of these 2-month intervals has kind of a different premium rate, and you can look them up for your specific grid. I've pulled the grid, one of the grids for Champaign County here, and basically intervals with higher rainfall variability are going to have not only a higher likelihood of indemnity payout, but that means they're also going to have higher premiums. So these premiums are going to vary by grid, and you'd have to look up your specific grid. You can look it up on USDA's decision tool, which I'll show later on. But you can get these for your specific grid that you want to insure in. Okay, so we're just going to go over some kind of basics of basic summaries of what's been going on with PRF use in Illinois. So far, so it was first introduced in Illinois, or allowed to be purchased in Illinois, in 2016. Since then, this shows the graph you're seeing shows the amount of acreage enrolled in each coverage level. And so you can see by far the 90% coverage level is kind of the most popular coverage level for PRF here in Illinois. And it's been pretty steadily increasing since that 2016 time period, or 2016 year when it was first available. This gives you an idea. So we talked about how you have to choose the months that you want to insure for this insurance product. And so this gives you an idea of, for Illinois participants, the proportion of pasture acreage that is insured in each one of these intervals. So you can see from this graph that July, August, September, and November, December are kind of the most highly enrolled months. Also May and June, July is also fairly popular as well. So that just kind of gives you an idea of what folks are actually enrolling in. So this graph shows this, what I call the producer gain ratio. So that's going to be any indemnities paid out, or all of the indemnities paid out in a year divided by the amount that was paid in by producers. So it's going to be the premium minus the subsidy. And so this is kind of illustrative because you can look at that line kind of towards the bottom where it's at 1 on the y-axis. You have indemnities are exactly equal to producer paid premiums. So above that line, you have that the indemnities collected were more than what producers paid in, and below the line, you have that indemnities were less than what producers paid in. So on average in the US, you can see that blue line, producers are receiving more on average each year than what they're actually paying in. In Illinois, this has varied a little bit, but you can see only about 2 of those years, 2018, 2019, did producers actually pay in more in premiums than they received in indemnity. So in a sense, this is partially due to the fact that it's subsidized. So this is something, you know, that can be thought of as kind of a subsidy to your operation. So just a few kind of closing thoughts on PRF. I think it's something that Midwest livestock and forage producers should consider in their operations, especially given that over that 2016 to 2023 time period, Illinois participants on average for each dollar that they paid in to this insurance product, they received $1.29 in indemnity payments. So it's kind of paying off over time. And these really, there's a lot of different customizable options to PRF that allows this to be a good product for a lot of different types of forage systems and large and small producers alike. So again, I went through this fairly quickly, and there are a few different resources that you can access on FarmDoc's website. Another webinar that I did last year, and then a couple of different articles that are written kind of about which months you should be considering for insurance and PRF. And I did reference this earlier. There is a decision tool online for PRF that can help you find your grid, and it can show you kind of what those premiums will look like, what your county base value is for your specific location. So you can use that to kind of inform your PRF decision. Okay, so switching gears a little bit, we'll talk about livestock risk protection. This is a price protection product that's available in Illinois for hog producers, for fed cattle and feeder cattle. And so this essentially establishes a floor selling price. And so there's going to be some cash index that's calculated. We'll get into the specifics of that cash index. But basically, this product will pay producers if the cash index price falls below the coverage price that the producer chooses. So it doesn't necessarily guarantee a cash price received because this is based on an index. So this is another product where you're not actually reporting anything to USDA or your crop insurance agent. You're not going to, report the actual price that you received. You are getting paid based on that index that is calculated. And so you still have to kind of consider basis risk a little bit within this product. So that risk that your local cash prices may not track exactly to the index prices. So that's something you'll have to kind of keep in mind and assess if you're looking into this product. So this is something for cattle producers right now. Prices are high, so I don't know that folks are really as interested in this, but it can protect against, those fluctuations. So we may have relatively high cattle prices right now, but within a given time period, that price may fall. So you may still consider this, especially since it's, a subsidized product. So this policy is really kind of a subsidized put option. So a put option, just to recall, is, you're purchasing the right to sell a futures contract at a given price within a certain time period. So that's kind of what this policy is doing, but you are getting a subsidy paid for you for the purchase of that kind of put option. And so you, with these LRP products, you choose the number of head that you want to enroll and their approximate ending weight. And then you're going to choose kind of the coverage price and corresponding coverage level and the length of time or that end date of coverage. So Again, this is like other USDA insurance products, the subsidies vary based on the coverage level, with the lower coverage levels, lowest coverage levels, so that 70% range, receiving the highest percentage subsidies, and the highest coverage levels are receiving the lowest percentage subsidies. So this gives the specifics for kind of the 3 types of LRP policy options that are available here in Illinois. You can see there are different head limits per policy. So for fed cattle and feeder cattle, each policy that you take out can have up to 12,000 head on that policy. For hogs, it's 70,000 head. And then you can see that there is, you can actually take out multiple of these LRP policies throughout a year. And so you just have an annual head limit where the year is going to run from July 1 to June 30th. So for fed cattle and feeder cattle, you can do up to 25,000 head total for the year. And for hogs, you can do 750,000. So the fed cattle and feeder cattle, you're going to have all of the products, you're going to have to put in that expected weight at the time of sale. And then there's different categories for kind of how much you can put in. And for feeder cattle specifically, there's a lot of different customizable options, which basically just adjust that the price index based on whether you're planning to market heifers, steers. There's even kind of categories for dairy cattle, for Brahman. So there are different options that will adjust that price index and coverage price that you're insuring. So getting into those price indices, so for fed cattle and for hogs, you're actually the price index is based on weighted average prices from USDA Ag Marketing Service. And so they're used to kind of calculate those different price indices. For feeder cattle, they're based on a weighted average of the CME feeder cattle index. And so there's going to be a price for each state. So Illinois has its own price for each of these. Prices could vary across state lines. And then again, you have to choose kind of the length of time that you want this policy to cover, so you can insure anywhere, or the lengths are anywhere from 13 to 52 weeks, so a full year out. So you can actually go online if you go to this link and see different coverage options. They vary daily, so they're going to be available on any day that kind of the markets are trading. And you just go to this website, you put in kind of what date you want the policy to be effective, and you start putting in a few other pieces of information, and you can glean some of these different coverage options. And so this is just an example. I pulled this in December of last year. Of what you would get. I put in Illinois, feeder cattle, heifers, and this just shows the 13-week endorsement length, but there are many other longer options as well. And so you can kind of see what would show up. And if you look at the kind of where are we at here? So the coverage price here, you can see that, this coverage price is kind of what price floor you're locking in. So if it falls below this coverage price, that's when you're going to get a payment. So you can see you have different options as you go further down, where you kind of have this like 100% coverage level up at the top, and then you go down and it goes as far down as 70% of that initial coverage price. And then you can also see over here where we have kind of the total cost of the insurance, but then this is the producer premium. So that's subtracted out the subsidy from, so that's the actual amount that you would pay per hundredweight. Okay, so I just zoomed in on that very top line to give kind of an example of what would happen with this policy. So again, you know, your indemnity is going to be based on whatever that coverage price is, minus what the actual end value at the time that the contract expires or the policy expires. And you're going to choose an expected ending weight, and that's going to be what your total indemnity payment is going to be based on. So, and then you also have to, you know, take into account, I showed where the producer premium per hundredweight is, it is shown there. So that's kind of what you're paying for that insurance. So just as an example, let's say, you know, this one was 13 weeks and it started December 6th. So if the March 7th ending value is 257, that is not lower than your coverage price of 254. So you're not going to get an indemnity, but the good news is that the, you know, markets moved in your favor. So you still get, you know, that benefit whenever you sell your feeder cattle. But you will have to pay that producer premium. So net, you're going to have to pay around $5 per hundredweight for that policy. So in the other scenario where, you know, that actual ending value drops to around 244 per hundredweight, then you are getting an indemnity. And so that indemnity is calculated as the coverage price minus the actual end value multiplied by your expected ending weight. And obviously you would still have to pay that producer premium, but net you would get about almost $6 a hundredweight from kind of purchasing that policy. And so, and I wanted to highlight with this kind of, with the decision tool or with the policy options that are available at that link, you can actually go back to recent or previous years and see what happened if you had taken out a given policy. So I just highlighted one here where the coverage price was $197 per hundredweight. The actual end value ended up being $248 a hundredweight, so there was no indemnity paid out in that year. So you can kind of see what happened given policies in previous years. So now we're going to go into kind of just looking at some of the LRP use in Illinois thus far. So it hadn't really been too popular for, this shows fed cattle and feeder cattle up until, you know, 2021. And that was actually because the premium subsidy rates increased starting in 2021. So you can see that folks thought this is more affordable. It actually probably makes sense for me now. And so they started enrolling. So there was about, you know, 1,400 head, 1,500 head of fed cattle enrolled and 1,400 head of feeder cattle enrolled in 2023. So for hogs, there's a lot more hogs that have been enrolled in recent years for this LRP product. Again, it picks up in 2021 primarily because we had that increase in subsidy. And so in 2023, you had almost 2 million head enrolled in this program. So again, I show this kind of idea of the producer gain ratio, and just to kind of show how this product is working. And so you see, you know, in a lot of the years, the producers are paying in more premiums than what they're collecting in indemnities. But I think what's useful to look at is, you know, in this kind of COVID time period where we had all of those supply chain disruptions and cattle prices tanked, you did have quite high payouts from this product. Similarly, hog prices kind of tanked in 2023. And so you can see relatively high payouts in that year because of this insurance policy. So it's something to think about for producers who want to insure against, you know, that downward price risk. So yeah, I think it can be really useful, especially for small livestock producers. Like I think we have quite a few of those here in Illinois. And this is huge because you're not going to need to establish a brokerage account, like if you were hedging or doing an actual option with futures markets. And you can actually insure animals on an individual basis if you really wanted to. And so this is a good product for these smaller producers. And these increased subsidies in recent years obviously have made it a little more affordable, so something to consider to manage that downward price risk. Okay, switching gears for maybe the last time today and talking about whole farm revenue protection. This is a crop insurance policy that's offered to cover all of the commodities on a farm. So it's not just going to cover kind of your corn production or your soybean production. It's going to cover corn, soybeans, livestock, everything that you have going on. And so this is something that USDA created to help specialty and diversified farms receive coverage because it's allowing coverage of traditionally uninsured items, different specialty crops and organic commodities. And it's, I think the goal was to simplify it to allow, all coverage under just one insurance policy. So, and up to $17 million in revenue can be insured with this whole farm revenue protection in a given year. So this is going to provide the farm against a loss of revenue due to things like, a decline in market prices, weather, different, things that are unavoidable causes of loss. And this is going to ensure the revenue you expect to earn from commodities that you produce during the insurance period, whether you sold them or not. And it includes animals, animal products, and you can actually include commodities that were purchased for resale as well. And so it's a little bit complicated how they determine what revenue is covered. But it's going to be your current year's expected revenue from a farm plan that you can kind of fill out and dictate on your own, or it will be a 5-year historic average revenue that's adjusted for any growth that you expect. So again, here we have coverage levels dictate kind of how much subsidy is going to be paid by the government on your behalf. With this product specifically, you have most of the policies are going to have that commodity count being 2 or more. The way that they count commodities with this policy is not necessarily straightforward. You can sometimes add apples and oranges, I think. But regardless, that for most of the policies are going to be 2 or more commodities. And so that 75% coverage level is going to be where you get kind of the maximum subsidy, or that 80% of the premium paid by the government. And I did want to note that you can buy whole farm revenue protection alone or with other policies. So if you already have corn and soybean revenue protection, you can actually still purchase those revenue protection policies, but you just have to know that the indemnities from those policies will count towards your earned revenue under whole farm. So just looking again at kind of what's been going on with whole farm use in the US and Illinois over time. So here's kind of a comparison of what's been going on across the US and in Illinois. So it really picked up right after whole farms started being offered, starting in 2015, and then 2016, 2017, there were a lot of folks who enrolled, and it's kind of, especially here in Illinois, it's trickled off a little bit, and now we're, under 10 policies enrolled in 2024. So that indicates there may be some issues with the policy. Maybe it didn't work as well for some folks as what USDA wanted it to. But regardless, there are some policies still being purchased here in Illinois. And just to look at the average liability per whole farm policy, so this gives you an idea of how much revenues are actually being insured per policy. You can see in 2024, in Illinois, it was 1.2 million per policy was the average that is being insured. It's a little below the US amount of 1.5 million per policy, but you could insure up to $17 million in revenue. So, yeah. And this is just to give you an idea of what folks are actually purchasing in terms of coverage level. So by far, we see the 75% coverage level is the most popular. And again, that's the one that was kind of the one that's getting you the 80% premium. So and this is just for Illinois, but in the US as a whole, looking at these numbers, it's even more stark that I think probably 90% of the policies that are being sold are at that 75% coverage level. Okay, to look at this gain ratio idea, again, in the US as a whole, you can see that on average, each year, producers that enrolled in this product were receiving much more in indemnity than they were paying in. In Illinois, this has kind of fluctuated around that equivalent mark, where some years you did have more indemnities collected, many years you had more paid in than indemnities collected. So it indicates, maybe it's not the subsidy levels aren't quite as high here in Illinois as maybe they might need to be in order to actually get us on the same page as some of the other folks that are using these throughout the rest of the US. So just a couple concluding thoughts on whole farm revenue protection. This is a good product for specialty and diverse producers. One of the potential disadvantages that I've definitely heard anecdotally is that it's very complex. You have to have 5 years of tax forms to determine your revenue that's covered each year. You have to file taxes before claims can be made. And so complexity is kind of one of the big downfalls, I think, of whole farm. But it might still make sense for big enough diverse producers. But there also is, for smaller producers, there's another option that started being offered in 2022 that is a more streamlined version of whole farm, and it's called micro farm. And so it's very similar, but it's for farms that are up to $350,000 in revenue. And that's going to have, it's intended to have less paperwork than whole farm. So that may be an option if you're kind of a smaller, diverse producer where whole farm is way too complicated for you. All of these different insurance products, they're all USDA products, so they have to be purchased from a USDA certified crop insurance agent. So you can go to this link or just Google USDA crop insurance agent locator and find a local insurance agent if you don't already have one. A couple of important dates for these insurance products. So LRP can be purchased any time of the year. So there's not really necessarily an important date for LRP. You just have to talk to a crop insurance agent. I think the first, you have to fill out some paperwork at first to get kind of the LRP options started, and then you can purchase LRP from that crop insurance agent multiple times throughout the year. With Pasture, Rangeland, and Forage insurance, that insurance policy starts in January. So the enrollment deadline is the December prior. So we've already passed the enrollment deadline for 2025 policies. But if you're interested, you could enroll by December 1st of next year for the 2026 year. And then whole farm revenue protection, this these are kind of based on the enrollment deadlines are county specific. So you'd have to kind of talk to your crop insurance agent to see. These are more, a little bit more in line with kind of the traditional crop insurance deadline of March 15th. So, but you could have a situation where you have to enroll by January 31st or February 28th. And in both of these cases, the premium payments are not due until after indemnities are collected. And so you know, if you have an indemnity, you get a payout, that goes towards your premium first, and you get back anything else that you would collect. And so, or in the case if there's nothing to collect, then you would have to pay in that premium. So if any folks that are still on here, that's kind of all I have to say about these insurance products. If you have any questions about them, I'm happy to answer them. You just need to go and find the question box in the webinar format. And I'll be happy to answer any questions if there are any. Okay. While if there's any questions, we'll talk about kind of some of the upcoming webinars, and we can go back to questions if any come in. But there are 2 more IFES webinars coming up on February 13th. We have management strategies with low incomes with Dr. Gary Schnitkey and Dr. Nick Paulson. And we also have on February 20th a farm policy update with Dr. Jonathan Koppes, which is always interesting as policies are changing daily, hourly now. And so we also have a couple of really timely upcoming webinars as well on highly pathogenic avian influenza. So this is something that's wreaking havoc on a lot of different producers and causing us to have high egg prices right now. So there will be 2 different webinars on February 18th and February 25th talking about avian influenza. So you can go to the link and sign up if you're interested in attending those. And we also just want to kind of thank some of our FarmDoc sponsors. We couldn't do it without them. So a few of them, TIAA and the Center for Farmland Research, CoBank, Compeer Financial, Corteva Agriscience, Farm Credit Illinois, Growmark, Illinois Corn, and Illinois Soybean Association. So we really appreciate our sponsors so that we can put on some of these different educational webinars and FarmDoc articles. And we also have a number of educational partners that we cooperate with and need to kind of thank. So I'm in the Department of Ag and Consumer Economics within the College of Ag, Consumer, and Environmental Sciences here at University of Illinois. And then we also have Illinois Cooperative Extension, the Gardner Agricultural Policy Program, and FBFM. Okay, so I don't think there have been any questions coming in. So if there are no questions, thank you guys for joining us. You can access all of our content on farmdocdaily.illinois.edu. We thank Jim Baltz, who's running everything behind the scenes here, making things go smoothly. So thanks all for joining today.